Hey everybody, I wanted to talk about a personal finance issue that is currently on my mind. So I'm buying a house and I'm thinking about, how could I potentially pay off the mortgage a little bit sooner than the 30-year term that I've signed up for. So not only do I have to think about the amount of money in addition to the mortgage payment that I'm paying on principal, but the timing related to those payments is also very important as well. So the math behind it shows the earlier in the term that you make those additional principal payments, the greater the benefit that you are going to have over the course of the loan. So what that means is you're going to pay more earlier and you're going to be saving much more on your interest over the course of the term, as opposed to if you made a smaller amount on a more frequent basis over a longer period of time. So here's the math behind it. So here's a spreadsheet that I put together with a few different examples. I used Microsoft Excel loan calculator with extra payments template that I downloaded earlier today. And I put together a few different scenarios. One being the normal loan calculation based on $200,000, annual interest rate 3.875% over 30 years. The next scenario I've got is if I have $10,000 and I make two principal payments, one at the 12th month of $5,000 and another $5,000 payment at the 36th or 37th month. The next scenario is if I have that same $10,000, but I break it up over a much longer period, making additional principal payments of $50 per month. The third scenario is if I had that same $10,000 and I make one blanket payment on month one of the loan. So here's how it shakes out. As you can see, I've summarized the data of all the different scenarios, looking at total interest paid and total interest savings. So here's my normal schedule of how much interest I'd pay over 30 years, $138,000. So now the next scenario, if I were to pay an additional $50 on principal for a number of years, up to $10,000 in total, I would save $12,000 in total interest. Okay, that's great. However, if I took that same $10,000 and broke it up into two payments, one of $5,000 at month 12 and another of $5,000 at month 36, I'd save a total of $18,000. So same amount, but a different schedule of payment. The third scenario is if I pay that same $10,000 in month one of the loan term and I don't make any more payments for the rest of the year. So how that shakes out is I'm going to save an additional roughly $375 over the last two $5,000 a month payments. So you could see if I have $10,000, the best thing to do is to put it all down on the principal as early as possible to realize the biggest savings on interest over the term of the loan. Hope you guys find this interesting. Give me a shout if you have any questions. I'd love to work through any scenarios with you.